Between 9 a.m. and 10:30 a.m. Eastern Time this morning, more wealth disappeared than the entire annual economic output of South Korea. Not over weeks, not over days, in 90 minutes. Gold fell 2%, silver fell 12%. And if you're thinking those numbers don't sound catastrophic, you're not understanding the scale. We're talking about $1.7 trillion evaporating from precious metals markets faster than you can watch an episode of your favorite show. Silver was trading at an all-time high of $117.75 per ounce at 9 a.m. By 10:30, it had collapsed to $103. That's a $14 swing. That's 12% of the entire value of the metal, gone in the time it takes to commute to work. And here's the part that should make you pause. This wasn't a surprise, at least not to people who knew what to look for. There's a chart, a 30-year chart, that predicted this exact moment would arrive. Not the day, not the hour, but the price level where everything would break. I'm going to show you that chart. I'm going to explain why this crash happened. And I'm going to walk you through what comes next, because what happened this morning is not the end of the story. It might just be the beginning of something much larger. Let me give you the timeline first, because the sequence of events matters. At 9 a.m., silver hit 117.75, a new record. Never in recorded history had silver traded that high. Gold was sitting at $500 per ounce, also near its peak. The precious metals market looked unstoppable. Traders were celebrating. Retail investors were posting screenshots of their portfolios. Everything looked bullish. Then the floor dropped out. By 10:30, silver was at 103. Gold had fallen to around 5,000. The crash was so fast and so violent that it triggered automatic circuit breakers on some exchanges. Trading platforms froze. Margin calls went out by the thousands, and billions of dollars in leveraged positions got liquidated in a cascade that fed on itself. Now here's what's strange. Gold dropped 2%, silver dropped 12%, same market, same time window, same global economic conditions, but completely different reactions. Why? That question is the key to understanding everything that happened today. And to answer it, we need to talk about something that most people have never heard of, but that controls more of the financial system than you might think. We need to talk about how futures markets actually work. And we need to look at a chart that goes back 3 decades. Most people think markets are simple. Price goes up when people want to buy. Price goes down when people want to sell. Supply and demand. Econ 101. That's true for physical assets. If you walk into a coin shop and buy a silver round, you pay the spot price plus a premium, and you walk out with a piece of metal. Simple transaction. But that's not how the vast majority of precious metals trading happens. Most silver and gold never gets touched by human hands. It trades as contracts on exchanges, futures contracts, and futures markets operate under a completely different set of rules. When you trade a futures contract, you're not buying the metal. You're buying a promise to deliver the metal at some point in the future, and you don't need to put up the full value of that promise. You only need to put up a fraction. That fraction is called margin. Here's how it works in practice. A silver futures contract on the COMEX exchange represents 5,000 ounces. At today's prices, that's about $500,000 worth of silver, but you don't need $500,000 to control that contract. You might only need $20,000 or $25,000 in margin. That $20,000 controls $500,000 of exposure. This is leverage, and leverage is what makes futures markets so powerful and so dangerous. Now, the entity that runs the COMEX is called the CME Group, the Chicago Mercantile Exchange. They're the ones who set the rules. They decide how much margin you need to hold for each contract. And last week, they made a decision that set today's crash in motion. They raised margin requirements by 47%. If you were trading silver futures with $22,000 in margin per contract, you now suddenly needed $32,500. If you were fully leveraged, fully extended, using every dollar of available capital to hold your positions, you now had a problem. You needed to either deposit more cash into your account immediately, or you needed to close some of your positions. Most traders can't come up with tens of thousands of dollars on short notice, so they sell. And when thousands of traders are forced to sell at the same time, the price doesn't just decline, it collapses. Because the selling creates more margin calls, which creates more forced selling, which creates more margin calls. It's a cascade, a liquidation event that feeds on itself until the leverage is wrung out of the system. That's what happened this morning. The margin hike was the mechanical trigger. It forced traders to sell whether they wanted to or not, but that's only half the story. Now I need to show you something that will completely change how you see this crash. From 1996 to 2014, silver traded inside what technical analysts call a descending channel. Imagine 2 diagonal lines sloping downward from left to right. The price bounces between them like a ball bouncing between 2 walls. For 18 years, silver moved up and down within that channel. And right in the middle of that channel, there was a line, a trend line. Let's call it the pivot line. In 2008, during the financial crisis, silver dropped all the way down to $8 per ounce. It touched that pivot line. And then something interesting happened. Silver didn't just bounce, it exploded. From $8 in 2008, silver ran all the way to $45 by 2011. That's a 462% gain in about 2.5 years. The pivot line acted as support, the floor. The price hit it and launched upward with extraordinary force. Now fast forward to 2014. The descending channel ended. Silver broke out and started trading in a new pattern, an ascending channel, 2 diagonal lines sloping upward from left to right. And silver has been climbing inside that channel for over a decade. But here's where it gets interesting. That same pivot line from the old channel is still there. It's still mathematically significant. And this morning, silver hit it again. Except this time, silver was coming from below. It was rising up toward the line, not falling down toward it, which means the line wasn't acting as support anymore. It was acting as resistance. The floor became the ceiling. In technical analysis, there's a concept called role reversal. When a price breaks through a support level, that level often becomes resistance on the way back up. And when a price approaches a resistance level that has been significant for decades, the rejection can be violent. That's exactly what happened at 9 a.m. this morning. Silver hit a 30-year trend line, a level that has defined major turning points in this market since the 1990s. The market rejected it hard. And this is why gold only dropped 2%, while silver dropped 12%. Gold didn't hit any major historical resistance. It just got caught in the sell-off. But silver hit the line that matters, the line that has been waiting there for 15 years. Now, if you're paying attention, you might be thinking, okay, so silver hit resistance and crashed. That makes sense. But does that mean the bull market is over? Should everyone sell and get out? Not so fast, because there's a pattern here. And the pattern is not what you think. The CME Group raising margin requirements at a market peak is not new. In fact, it's happened at almost every major top in silver's modern history. In 1980, two brothers named Nelson Bunker Hunt and William Herbert Hunt had accumulated massive positions in silver. They controlled roughly 1/3 of the world's deliverable supply. Silver went from $6 to $50 in about a year. It was a speculative frenzy. Then the COMEX implemented something called Silver Rule 7. It restricted margin buying and put heavy limits on how much any single entity could hold. Silver crashed from $50 to $10 in a matter of weeks. The Hunt brothers went bankrupt. It was one of the most spectacular financial collapses in American history. Fast forward to 2011, silver had climbed from $8 after the 2008 crisis to nearly $50 again. Another parabolic move, another mania. And then the CME raised margin requirements. Not once, not twice, 5 times in 9 days. Silver crashed from 50 to below 30 in a matter of weeks. And now in 2026, silver ran from around $30 to $117 in roughly a year. And the CME raised margins by 47%. Silver crashed 12% in 90 minutes. Same playbook, different decade. But here's the part that nobody seems to be talking about. What happened after those crashes? After 1980, silver entered a brutal 20-year bear market. The crash was the end. It took 2 decades for silver to recover to its previous highs. But after 2011, something different happened. Silver did drop. It fell from 50 all the way down to below 15 over the following years. It was painful. It wiped out fortunes. But the bull market didn't end. It paused. And over the next decade, it came back. Slowly at first, then faster. And now silver is trading above $100. So the question is, which type of crash is this one? Is this 1980 or is this 2011? To answer that question, we need to look at something that almost nobody is paying attention to: the gap between paper prices and physical reality. While the futures price of silver crashed 12% this morning, something strange happened in the physical market. Premiums went up. If you tried to buy physical silver from a dealer today, you didn't see prices drop by 12%. You saw premiums increase. Dealers were barely lowering their prices at all. Some actually raised them because demand spiked. Bargain hunters were trying to buy the dip, and physical supply is tight. This is the divergence that matters. The paper market says silver is worth $103. The physical market says, no, it's worth more than that. And the gap is widening. Now, most people don't understand how disconnected these two markets are. The COMEX, where silver futures trade, has something called registered inventory. This is silver that's actually available for delivery if someone wants to take physical possession of their contract. Right now, there are about 28 million ounces of registered silver in COMEX vaults. But there are open interest contracts representing roughly 10 billion ounces. That's a ratio of 356 paper claims for every 1 ounce of physical metal. 356 to 1. That's like an airline selling 356 tickets for every seat on the plane. It works fine until everyone shows up to board, and then the system breaks. Now, most futures contracts never get exercised for physical delivery. Most traders just settle in cash. They close their positions before expiration. The system is built on the assumption that physical delivery is rare. But what happens if that assumption changes? What happens if a significant percentage of contract holders suddenly demand physical metal? We saw a preview of this in the nickel market in 2022. Nickel was trading at around $20,000 per ton on the London Metal Exchange. Then physical supply got tight. A short squeeze developed, and within days the paper price exploded to over $100,000. The exchange had to halt trading. They canceled trades. They rewrote the rules. It was chaos. Could the same thing happen in silver? Nobody knows for certain. But the divergence between paper and physical is a warning sign. Now let me give you the case for why this crash might actually be a buying opportunity and not the end of the rally. The fundamental supply and demand picture for silver has not changed at all. Not this morning, not this week, not at all. On January 1st of this year, China implemented export restrictions on silver. They didn't ban exports completely, but they put heavy controls in place. China accounts for roughly 60 to 70% of global silver supply. That restriction is still in effect. Industrial demand for silver is exploding. Solar panels need about 200 million ounces per year, and that number is growing. Electric vehicles need silver. AI data centers need silver. 5G infrastructure needs silver. None of that demand went away this morning. The structural supply deficit is still the worst it's been in decades. For 5 consecutive years, demand has exceeded supply. The cumulative shortage is roughly 820 million ounces. Inventories have collapsed. Registered silver at COMEX is down 70% from its peak. Physical silver in Shanghai is still trading at a $6 to $9 premium over the paper price in New York. If the bull market was truly over, that premium would collapse. It hasn't. And here's the most important point. In 2008, when silver touched that pivot line at $8 and then went on to gain 462%, the fundamentals were not this strong. There was no China export ban. There was no solar boom. There was no EV revolution. There was no AI infrastructure build-out. The fundamentals today are arguably the strongest they've ever been in silver market history. Yet the technical setup triggered a crash anyway. This is the tension you need to understand. Technical factors can cause short-term crashes, even when fundamentals are screaming bullish. The question is whether the technicals will ultimately bow to the fundamentals, or whether the fundamentals will bow to the technicals. Historically, fundamentals win over the long term, but technicals can create tremendous pain in the short term. Let me zoom out for a moment and give you some perspective on what we're actually watching here. Global debt is at all-time highs. The United States alone is carrying $38 trillion in debt. That debt cannot be paid back in real terms. It can only be inflated away, which means central banks will keep printing money. The Fed just announced $45 billion per month in reserve management purchases. That's $540 billion this year alone. That's not stimulus, that's not QE, that's just baseline liquidity injection. When you print money, the value of that money declines. And when the value of money declines, the value of hard assets tends to rise. Gold, silver, real estate, commodities. This is not a new phenomenon. This is how monetary systems have worked for centuries. Now, silver has something that gold doesn't have. Industrial demand. More than half of all silver demand comes from industrial applications. It's not just a monetary metal. It's a critical component in modern technology. And the industries that need silver are growing, not shrinking. Solar panel production is accelerating. The world is installing record amounts of solar capacity every year. Electric vehicle production is ramping up. AI is consuming staggering amounts of electricity, which requires infrastructure, which requires silver. 5G networks are being built out globally. Every one of these trends increases silver demand. And supply can't respond quickly. 75% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. You don't just open a new silver mine when prices go up. New mines take a decade to develop. Supply is inelastic. So you have explosive demand growth, structural supply constraints, monetary debasement, and a market that's historically undervalued relative to gold. That's the fundamental case. And none of it changed this morning. So here's where we are. Silver crashed 12% in 90 minutes. The crash was triggered by a margin hike combined with hitting a 30-year resistance level. Thousands of leveraged traders got liquidated. $1.7 trillion in value disappeared from the precious metals market. But the fundamental picture is unchanged. Supply is still tight. Demand is still growing. China's export restrictions are still in place. Physical premiums are still elevated. The paper-to-physical ratio is still absurdly stretched. The crash felt like the end of the world if you were long silver this morning. But crashes don't happen in bear markets. Crashes happen when bull markets get overheated and need to cool off. The fact that silver crashed from 117 means silver got to 117 in the first place. A year ago, it was at 30. The trend is still up, even if the day was down. Now, will silver break through that 30-year resistance line and go parabolic again? Or will it roll over and then enter a prolonged correction like it did after 2011? I don't know. Nobody knows. Anyone who tells you they know for certain is lying to you or lying to themselves. But I'll tell you what I'm watching. I'm watching the $100 level. If silver holds above 100 and consolidates there, that's bullish. If it breaks below and keeps falling, that's a different story. I'm watching physical premiums. If they collapse, demand is weakening. If they hold or increase, the supply squeeze is still intact. I'm watching COMEX inventory. If it starts rising, the squeeze is easing. If it keeps draining, the pressure is building. I'm watching China. If they reverse the export restrictions, the game changes. If they tighten them further, the squeeze intensifies. And I'm watching the CME. If they raise margins again, more forced liquidation is coming. If they hold steady, the worst might be over. 4 out of 5 of those indicators are currently bullish, but that doesn't mean the pain is over. Markets can stay irrational longer than you can stay solvent. $1.7 trillion disappeared today, but it didn't vanish. It transferred. From one set of hands to another, from the leveraged to the unleveraged, from the weak to the strong, from the emotional to the patient. The question is, which side of that transfer are you on?